where we put our money, whether it's pre-tax or after-tax, will determine how many more checks we write to the United States Treasury. It's the type of investment that will dictate the amount of tax that we owe. Let me give you an example. I'm going to show you 3 buckets, and let's assume each bucket has $1 million in it. Now, the first bucket I'm going to call a qualified retirement plan, where I have been able to contribute on a tax-deductible basis, and I've struck it very well, and I've got a $1 million balance. Now, let's assume the second bucket is non-qualified money. It's a brokerage account where I, after tax, the money that I have left over after I've been taxed is going to be invested. Could be in the same investment that the IRA is in or the qualified retirement plan is in, but I choose to invest after tax. Now, I have $1 million in that account as well. And let's assume over my lifetime I've put in roughly half and the account has basically doubled. And I've been paying taxes on the distributions as they were being taxed to me, so my cost basis is half. And the third bucket is something we call cash value life insurance. Let's assume I have $1 million in cash value. What I would like to do is I'd like to show you how wealth is spent, not accumulated. How wealth is spent. And let's assume that I were to call each of my brokers, the broker that has the qualified retirement plan, the broker that has my brokerage account, and my broker who owns or helps me with my life insurance policy. And I ask the broker to send me an 8% distribution. Now, I'm not earning 8% necessarily anywhere. I just want $80,000. Now, in the IRA, it's all taxable. In the center bucket, the brokerage account, again, half of that money is my own. There's 3 ways I can compute the taxes due that are on that distribution. I choose the actual price per share method. And here I've pegged the value of the distribution at $40,000 return of principal, $40,000 subject to, if held for 13 months, long-term capital gains. Now, you won't hear this very often, but is there a favorable tax in the tax code? Yes, there is, the long-term capital gain. So in that example, my $80,000, 40 of it is free, return of principal. The other 40,000 is subject to, and 20% under the current tax code, long-term capital tax rate. I owe about $8,000. Now compare that to the IRA, where I pulled out $80,000, and it's stacked on top of every other 1099 and W-2 I have. And the highest tax you could pay on that would be $36,000 and change. $36,000 from that million, $8,000 from the second bucket's million, and then you got the third bucket. You call $80,000 loan. There are no income taxes due on that loan. As a matter of fact, if that's my only distribution that year, I qualify for food stamps, government cheese, free cell phones, Obamacare, and I don't even have to file. All my Social Security comes to me free. I pay the lowest Medicare premium in existence, and I don't even have to file. $36,000, $8,000, zero. $1 million, $1 million, $1 million. When you understand how wealth is taxed on the distribution side, what you have been saving by paying less tax today, you owe the most tax when you retire. Is that really the method you want to use to accumulate wealth?